Hey everyone, welcome back to Meet Kevin report number. Whoops, actually, that number is totally wrong. I gotta fix the number we're on. We're definitely a lot further along than number 49, so we're gonna go ahead and fix that number. But welcome back to another Meet Kevin report. It is April 11th. We're going to start with CarMax. Let's see what went on with CarMax's earnings. Then what we'll do is we'll jump into some talk on Bitcoin. We've got consumer talk, market talk, a lot of different things to cover today, as usual. So thank you so much for being back here to another Meet Kevin report. We are actually on Meet Kevin report number 79, so that has been fixed. Thank you very much. And there we go. Welcome back to 79. Okay, so first, CarMax. CarMax just reported. Let's see here. Let's pull this up here and see exactly what we just had happen over at CarMax. Okay, perfect. CarMax reported earnings per share of 44 cents versus the estimate of 20 cents. Used vehicle sales came in slightly below estimates, so a better bottom line, but weaker top line on used vehicles. $4.53 billion of revenue on used car vehicles versus a 4.8 expected. Looks like CarMax bought about 262,000 vehicles from consumers and dealers in the fourth quarter. That was down about 22.5%. So it looks like either people are selling fewer cars because maybe they're just like in real estate locked into lower rates, or for some reason CarMax is sort of offering worse deals. I would expect that is a combination of both, that consumers are more hesitant to sell their car and buy a new one because they would be adjusting to a higher interest rate. And CarMax is probably trying to protect their bottom line more and is offering worse deals to people who are interested in actually turning in their vehicle. And then you've got CarMax affirming that they plan to sell between 2 to 2.4 million vehicles through retail and wholesale channels by the next fiscal year. CarMax is planning new store growth in 5 locations. It does actually look like this million vehicle sales is by fiscal year 2026. Right now, they are on fiscal 24. Gosh, they make this so confusing. Actually, I think they're on Q4 2023. Who comes up with these stupid calendars? Good lord. Anyway, looks like they're spending more on CapEx than expected. That's actually surprising. Expected to spend 450 million on CapEx versus 380.7 expected. And that's surprising because if we truly are walking into a recessionary environment, generally you see companies pull back on capital expenditures, not actually accelerate them above expectations. CarMax posts lower fourth quarter. Yes, it must be 23 here. Lower fourth quarter as inflation weighs on demand. And CarMax actually up 7% in pre-market as that EPS beat seems to be driving the stock movement. So a little bit of insight into CarMax. I'd be very curious to see what their average sales price per vehicle has been and how that's compared to prior quarters. We'll go through that in the course member live stream, and we'll have the earnings call a little bit later as well, which will be neat. So then we have to talk about BTC. Before we do that, I do want to look at break evens quickly. Let's get the 5-year break even and financial conditions. So we'll get the Goldman financial conditions and the 5-year break even. Let's pull these here. All right, let's see here. We have 5-year break even, Goldman Sachs financial conditions. Let's see how and if those are tightening at all. The 5-year break even as well for inflation expectations. So we do have Goldman Sachs financial conditions slightly ticking up again. They've fallen substantially after the banking crisis, but a slight minor move back up. I'll show you both of these in just a moment here. We've got the 5-year break even also stable, which is nice to see that it is stable. It's not falling. That would be preferred, but anything is better than a skyrocketing inflation break even, especially going into this inflation report that we have tomorrow. Tomorrow at 5:30 a.m. Obviously, we'll be live covering the inflation disaster of whatever it may be tomorrow. Here are the charts for this is your Goldman Sachs Financial Conditions Index. You can see slight little tick up over here, but down from the banking crisis. And then when we look at the 5-year break even, what do we see here? See that stabilization on the right. So that's still removing this sort of end of February, beginning of March insanity of a run that we had here. Not as weak as what we had during the banking crisis, but somewhere in between that. So relatively normal here. Nothing too scary there. Okay, now we've got to touch on BTC because it's made some nice movements here, and we'll see what kind of explanations we might have. Okay, let's see. Run by for Bitcoin. There is now a case being made for banning Bitcoin, while at the same time, you actually have Bitcoin hitting new record highs. Let's talk about that first because we have not seen over $30,000 per Bitcoin for over a year. And we sat at the 28.2 level for a solid 3 weeks, which was actually pretty impressive because it felt like during the banking crisis, the safe haven was Bitcoin, which is pretty remarkable because as the banking crisis really took hold, we actually went from a low of about 20,000 when the banking crisis started to about that 28,200 level where we sat between about March 17th and about April 9th. It's pretty damn impressive for Bitcoin. Now, on one hand, there's an argument made that a lot of this is driven by, and after all, we know statistically that over 80% of trading volumes for Bitcoin are on Binance. But some folks are making the argument that Binance is potentially manipulating the Bitcoin market conveniently as the occurrences like this happen in the market. Now, what could potentially have been the catalyst over the last few days? Well, some people suggest the oil and the de-dollarization movements. So, in other words, you have one argument that says, look, Bitcoin is rallying because obviously you want to escape the dollar, you want to escape the Federal Reserve, you want to escape CBDCs, and you want to escape sort of government control and oversight, and you want that freedom. That's the one argument, right? That essentially, while we have a banking crisis and the fringes of the banking sector collapse, which fringes is a pretty generous word to use, given that Credit Suisse was a pretty massive bank and pretty integral to the Swiss banking system. But then you have these fears that okay, well, if OPEC is still controlling oil and by having a production cut of a million barrels a day, they can affect the price of oil so substantially. And clearly, the reserve currency of the dollar is at risk when that same organization and individual member countries of that organization start considering using or even start using other countries' currencies like the Chinese yuan or renminbi to start transacting in oil. That's creating this sort of dual pressure potentially for Bitcoin. And so you really have three things going for Bitcoin. You have the banking crisis, you have the de-dollarization thanks to walking away from the petrodollar, but then you also have this third argument that look, maybe we're looking past the recession. Maybe Bitcoin is the tool that says the recession, if it comes, it's not going to be that bad. The biggest culprit here is inflation. And we're going to go back to money printing once inflation is gone, and we'll go right back to below 1% interest rates, which is pretty much what the IMF said today. We will be going back to 1% interest rates, believe them or not, whatever. And potentially, Bitcoin is just trying to pre-price in what is to come in the future, which makes sense because to some extent, markets that trade freely like to pre-price in what could occur. So that way you're not last to the party, so to speak. And that's why potentially for those three reasons, Bitcoin could be moving up, breaking now that 28 to 2 previously resistance level and pretty strong support level. It's been bobbing around above and beyond that level. And now we're above 30,000, which potentially sets us up on a course to head back to the next Fibonacci retracement level, which would be 35,900. But at the same time, as this is all coming to a head, now there's talk about potentially banning BTC now, or just banning crypto entirely. Now, I generally don't love talking about this because people usually get mad at me when we talk about this. But I'd like to see what the argument is that people are making for banning BTC. And this is a foreign affairs piece, which I generally respect foreign affairs. But let's see what argument they make here. It's also worth noting that some folks on the sort of anti-crypto side do make the argument that, hey, if Binance controls 80% of market flows because of people using Binance, is that necessarily a bad thing? It just means they had commission-free trading for Bitcoin. Maybe that's why they have 80% of the flows, because they were smart. Well, according to analysis by Morgan Stanley, which a lot of folks in the crypto community don't believe as far as they can throw them anyway, but Morgan Stanley believes that the biggest traders during the banking crisis were actually whales, that is likely brokerage accounts, not individual retail traders. So if it was whales driving crypto pricing or Bitcoin pricing, then perhaps there is some convenient manipulation happening, especially since Binance did liquidate USDC reserves they had in favor of buying Bitcoin. Now that ends up looking like a really good decision because they got a great deal, right? And the value of that BTC has gone up, which is fantastic. But it does make you scratch your head on how much risk is this company taking. And that is something that people are very fearful of right now in markets because, well, ultimately, the more risk an exchange takes, the more of this chance you have of creating potentially another FTX, which nobody wants to hear about. For example, FTX made headlines yesterday for their nonsensical arguments that they basically they had such loose accounting practices that they would sometimes just happen to accidentally just find $50 billion, or sorry, $50 million sitting around in an account somewhere and have absolutely no idea what that $50 million was for. That was an example of Binance for or FTX for you. Now, hopefully, Binance is substantially different from FTX, but we don't know because we don't have audits. We don't have proof of reserves audits anymore. Those have been canned, and we do not have any kind of audits that give us insight into how much debt this company actually has. Those are both very important. So, what is the potential argument that Foreign Affairs is making? And what is the case for banning, as they say, crypto? Well, let's jump into exactly that piece. I do think, I want to be very clear, okay? I want to disclaim this away, that even though we're going to look at this piece, it's okay if you like Bitcoin. It's okay to look at what another argument is. And they do actually make some interesting arguments that again, whether true or not, or valid or not, are worth considering. So let's take a look at this. Here is the piece, and we're going to go through this together. I am going to throw up the banner for the coupon codes because that coupon code does expire tomorrow for the programs on Building Your Wealth, linked down below. So what could the case for banning crypto actually be? Well, let's find out. So they start their article by talking about FTX, which isn't that entertaining. Oh, come on. There we go. They start their article by talking about FTX. But take a look at this. But FTX's unraveling was not an isolated incident, they say. Rather, it revealed a fundamental flaw in cryptocurrency. My goodness, what is going on with this computer today? There we go. It revealed a fundamental flaw in cryptocurrency, in the cryptocurrency industry. The root of the problem is that cryptocurrency assets can be created at no cost and without limit. And an unlimited supply of assets makes the system more vulnerable to booms and busts. Now, I thought that was a really interesting argument because I'm thinking about it. I think what they're saying, and this was sort of my initial thought when I was hearing this, is I think what they're saying is if you have crypto institutions like, let's say, a Binance that says, hey, look, we will lend against whatever crypto collateral you have, then you essentially create a fractional reserve banking system, much like the traditional banking system, right? The difference, though, is rather than a country being able to create a currency, anybody and their mom can create their own currency, which if it has some deemed market value, which could be based on a very thin order book and with very horrible fundamentals, if a company starts lending against that, whether it's in the DeFi space or the more centralized space like a Binance, well, then you essentially can create this flywheel of infinite money. And this is how you can actually prop up the boom and bust cycles substantially more. When assets have nothing behind them and no reliable financial accounting practices or valuation techniques, because you can't value them based on income, you can value them based on use, right? And that's generally what people do with Bitcoin or Ethereum, is we look at what's the value of the use, the utility, and what's the value of demand compared to supply, which is difficult to measure because sure, that takes you right back to, well, how much is Bitcoin being used for transactions? But generally, you're not using Bitcoin terribly much for transactions. I venture to say that most people are using it for a store of wealth, unless, of course, you're sending money overseas, and then in which case you're probably using stable coins anyway. So, but this is very interesting. The root of the problem is that cryptocurrency assets can be created at no cost and without limit. When assets have nothing behind them and no reliable financial accounting practices or valuation techniques exist to expose fraudulent manipulation of assets, the result is fraudsters have rushed into cryptocurrency, exploiting the complexity and hype as a way to dupe basically the normies, to dupe the people who are completely clueless about how cryptocurrency can actually be manipulated. And this is frequently seen, obviously, in the historical artifacts of what happened with FTX, but also when we look at, hey, why are we no longer even doing proof of reserves, Mr. Binance, Mr. CZ? Oh, not doing proof of reserves anymore because you don't want to. Okay, got it. And you got dumped by the auditing firm because they think the reports aren't being trusted by people anymore, as they really shouldn't. And then when CZ provides proof of backing, we tend to get very overlapping wallets, which does, on one hand, make people who are super pro Binance, super pro CZ say, "Oh my gosh, he's a god. He posts all his transparency." But when you actually go to the transparency, these wallet chains, you're like, "Wait a minute, we're double accounting some money and we can't follow through with all of the transactions that are actually occurring because there are things purposely left out." And there's so many wallets that these exchanges have. As transparent as crypto is, and as simple as it is to make the argument that, oh, crypto is transparency or is transparent, it's actually extremely difficult to follow along with most crypto transactions unless you have a complete map of every single wallet that an entity has, and it's very difficult. This is why there are actually analytic firms designed to try to stitch this all together, because it is so complicated. It's almost not meant to be understood by a normal person. It's pretty wild. But anyway, cryptocurrency concerns. Cryptocurrency already facilitates many different kinds of harms. And this is a pretty like Janet Yellen style argument right here. Iran and North Korea use cryptocurrency and the anonymity they create to evade sanctions and launder money. See, this gives you sort of the other example. It's like, hey, it's so transparent that criminal entities or state sponsors of terrorism can use them to basically skirt sanctions. Hey, we need to go buy stuff from Turkey because we can't buy it from Russia anymore. Here's crypto payment. Go turn it into, a stable coin or whatever afterwards if you want. Which they do. In 2022, for example, Pyongyang reportedly stole $1.7 billion in cryptocurrency, which it is believed to be using to fund ballistic missiles and nuclear weapon development. So look at that. Here's an example, a report by Foreign Affairs suggesting that North Korea stole $1.7 billion in crypto, and now they're using it to develop their nuclear weapons program. It's intense. That's a pretty big allegation. Bitcoin has become the most common form of payment for ransomware attacks, increasingly targeting businesses and public services because it allows the nefarious actors behind these attacks to receive large amounts of money quickly and anonymously. Cryptocurrencies are also increasingly being used to facilitate drug and human trafficking. And basically, without knowing who's using these wallets, the crypto chains are relatively anonymous. If allowed to proceed unchecked, the unrestricted growth of the cryptocurrency industry and its future integration with the traditional financial system could produce a major crisis. Blockchain-based finance is complex, automated, and highly interconnected. It offers vast opportunities for creating leverage because there's virtually unlimited supply of assets to borrow against. This is what I talked about earlier with if anybody and their mom can create a currency and an institution will lend against it, you do create essentially infinite money. These are the kind of fragilities that led to the last financial crisis in 2008. This damaged trust in the traditional financial system, and the cryptocurrency industry wandered into the wreckage, promoting itself as a reliable alternative to banks. So basically, in 2008, when we had infinite money in the traditional system, people stopped trusting the traditional financial system so much that it essentially created crypto, and now crypto is potentially following in the same footsteps. There's the danger that members of the cryptocurrency communities, embittered by their losses, may also be funneled into extreme online communities. I think this is a little bit more of an extreme example here. Basically, people are going to turn into loose cannon maniacs because they lost money in crypto. Industry leaders and lobbyists tend to argue that the primary benefit of crypto is decentralization. Unfortunately, that is unrealistic. The economic incentives of crypto have led to extremely concentrated pools of transaction validators, leaving users dependent on those small groups of people. I mean, that's true. When you look at the controls, for example, of Ethereum, you're looking at Lido being a massive player in the space. And now with Ethereum 2.0, the idea is we have more centralization, but still staking pools, what they really do is centralize control into fewer groups. Now, many argue, well, that's not necessarily a bad thing because people are going to the most reliable validators, the ones who have the lowest incentive to actually do something wrong or nefarious, because then they would lose all of the incentives and payments that pool would otherwise be able to generate, and they'd essentially be shooting themselves in the foot. So there's some counter arguments to this. I think really the best argument they make is this infinite money argument. I think that's great. Otherwise, so far, the arguments here are some of the pretty traditional anti crypto arguments. Misleading rhetoric about crypto's decentralization is being used to persuade regulators that software is calling the shots, implying there are no business entities or humans to regulate. But the reality is that regulation can be applied to many different intermediaries. They're talking directly to Congress saying, look, companies like Binance are going to tell you it's all robots and algorithms that are controlling this. But the reality is there are plenty of people behind the curtain that make movement decisions. CZ is a perfect example, and who knows? They could end up being and then maybe they will be the survivor in this cycle. I hope they survive, because if they don't survive, it's just going to hurt more of the financial ecosystem. I personally am just a big fan of not your keys, not your crypto, and I think it makes all of this a lot simpler. Get your money off exchange, right? But if policymakers are reluctant to adopt an outright ban, then the second best alternative is to stringently enforce regulations that are already in place. Banking regulators should use existing prudential rules to keep banks from being exposed to the risks of crypto. Now, I don't think anybody argues that some regulation would be nice in crypto. I mean, when you look at Coinbase, they're basically begging for regulation. They're basically saying, hey, please give us regulation. Tell us what the rules are so we can play by them, as opposed to the game we have today, which is we're going to try to do our best, and then we're just going to keep getting sued by the SEC and Commodities Future Trading Commission because nobody's actually telling us what the rules are. And now you're trying to litigate your way to actual authority, which is the inappropriate way to do it. Congress should actually bestow upon you rules to enforce, which then you are dutied or designated to enforce. And then those rules could actually be followed or not followed and then duked out in court, rather than, oh, we don't have any laws. Let's deputize the SEC and the Commodities Future Trading Commission and turn them into cops where they make their own rules, and then they find out if those rules are accurate or not in court. Like it's super backwards right now how crypto is being regulated. Super, super backwards. And that's a big problem. And that's not to say there's not also a big problem with potentially some of what's going on at Binance, and potentially this infinite money glitch that you could have with crypto. I think those are realistic problems, but I do think regulation can help, especially with that infinite money glitch. And then that's exactly why companies like Coinbase vet their coins before they allow them on platform to lend against anyway. Now, to what extent that vetting is, nobody really knows because, again, no regulation. Greater concern is the development of an offshore currency industry. See, this is the other issue is when you don't regulate properly here, what you're basically just doing is you're pushing people more out of the United States. And so Foreign Affairs makes a very good argument here at the end. They said the United States should continue to take part in the efforts to limit crypto at a global level by actually regulating, right? And so maybe it's not so bad if we can actually get some good regulation in that would prevent some of the problems with it. Big fan of that. So I'm not a big fan of banning crypto, but I'm a big fan of actually getting to the point where we have some regulation. I think that would be fantastic. I also think Bitcoin often is a good leading indicator of potentially what's to come in the stock market, which in the short term, I think is actually fantastic that we've just broken through that 28.2 level. And I think we're on that path to 35.9. Am I knocking on the door of looking at $1 million for BTC in the future? Who knows? I mean, if BTC runs to 150K over the next 1 to 2 years, that could be enough of sort of starting the flywheel to get people going, oh my gosh, this is the greatest thing ever. Now, will that potentially lead to a 2008, like Foreign Affairs projects, could end up happening? Who knows? Maybe it won't be this cycle that we get crypto regulation. Maybe it'll be the next boom cycle and then the bust cycle that actually leads to appropriate crypto regulation. Who knows? But we'll see. So that gives us a little bit of insight into what's going on with BTC. Make sure to check out those programs on Building Your Wealth, link down below, and the expiring coupon code, which ends tomorrow. All right, next topic to cover. So that was BTC. Now let's go ahead and look at what consumers are up to, as well as the bear case. Yes. Yes, 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 yes. All right. Let's start with the bear case one, because this is an interesting piece. And let me see here. Okay, let's get into here. Stand by. There we go. All right. This could be interesting. This is a bear argument on how the markets could move lower. I wanted to add commentary to this because I always like to look at what the bears are saying and then that makes the argument potentially as to why the bears are wrong or why the bears are right. Visor. That's a new word. Visor. All right, come on. Now, how am I going to do it? Ah, yes. All right. There we go. All right, that's ready. All right. Let's now take a listen to the bear case for a lower and potentially plummeting S&P 500. Let's take a listen in to see what arguments they have and then add some commentary. We'll jump on into CNBC. That is not CNBC. This is CNBC right here. Let's listen in to what they got. Remember, we've got that expiring coupon code tomorrow, CPI day. Prices will be going up, so get that lifetime access before the end of tomorrow, April 12th. Let's listen in.
Jason Trenner, another week.
Nope.
Another week. Chairman and CEO of Strategas. Jason Trenner.
There we go.
Another. I still need to figure out why. I mean, you're staying cautious. You're staying kind of bearish.
Yeah.
You have watched 4,100 hold. I don't know why it's holding on the S&P. And here's my question to you. What don't we know that causes you to think that we could have another, I don't know, what do you think? We could do 10, 15% lower or something? Why don't we know everything? Why isn't everything already out on the table? What would be significantly worse than we already?
What we have, let's say, let's put it this way: what we haven't seen, is a significant weakening in the labor market. And I would say there's never been a news cycle that starts when the unemployment rate is 3.5. So I would argue, almost by the very nature of a business cycle, and I think this is going to be a real business cycle, unemployment's going to have to move higher. The other thing we really haven't seen is significant or persistent weakness in earnings. So we had 1 quarter of down earnings in the fourth quarter, and it looks like in the first quarter, which is going to start in the next week or so, you're going to have a second down quarter year over year. And to me, those are two big things. The other moving part in this gets maybe a little too maybe too pie in the sky, but we have to see what Treasury yields look like when the debt ceiling is increased. You know, part of the reason why I think yields have come down is partly because the Treasury is not issuing treasuries because you've hit the debt ceiling and you're drawing down the general account. And ironically, I think once you increase the debt ceiling, there is a chance that long-term interest rates rise.
Were you expecting the move from the October lows?
No.
To reach all the way back to 4,100.
No,
so you were not.
No, absolutely not. And we've been, as you know, we're like the Tina people. We were bullish for 8 years. We got bearish last year.
What are we calling it now? There are alternatives.
Tara.
Tara.
I think you just need Tara. Yeah.
But
did you coin that too?
No, we didn't know.
ChatGPT coined that.
Yeah, I'm sure it did.
Okay.
I'm sure it did. But listen, we got bearish a year ago. Looked like a great call, but like as this market does, it could make you look foolish, and we felt pretty foolish for a good portion of the first quarter. But I'm kind of sticking, Joe, to the kind of the core concepts.
I saw your notes,
which is to say that, listen, it's generally speaking, if you have a tightening of Fed policy, if you have a tightening of credit standards, you have lower profits. Those things are generally don't.
I just don't understand why we don't already see more. I don't know why it's holding at 4,100.
But I mean, if the S&P is Apple and Microsoft is 13% of the weighting,
that's one reason.
They hold, and we've certainly seen that sort of bid to quote unquote safety. And I put them in quotes because who knows if they're really safety out of the banking crisis, Jason. So to the extent that tech is that tentpole for the markets, what point do you think we need that to crack in order for the S&P 500 to crack.
Well, I think that's where all the weights are.
Yeah.
And I think that's true as far as the indices are concerned. But I would also say for your average investor, who probably owns a lot more than just 10 stocks that were up meaningfully in the first quarter, their statements that they're getting right now are probably not as reflective as of good news as, let's say, the NASDAQ was, or even the S&P 500. So that's another moving part in this. If we're talking about the individual investor, is that probably the indices belie what they're actually seeing on their statements, because I would say that there's a clear slowdown in economic activity. And I would say whatever your odds were of a recession before Silicon Valley Bank failed, they have to be higher now. Ours were high before that happened, but it seems to me every bank in the country now is looking at its loan books. Every bank in the country is now tightening lending standards. And the Fed should keep that in mind.
So maybe multiples are too high and earnings are too high. Okay. So you get a double whammy. We're at 4,100. Are you a 3,500 guy or are you a 3,200 guy?
I'm more of like a 3,200 to 3,400 guy.
You are?
Yeah. If you use,
that would be gut wrenching.
Yeah, but I mean, we're
over time, like a slow, steady, just hideous decline for the next year.
Frankly, I get a lot of.
Keep in mind, that's about a 22% decline. And really, this bear is giving us a 22% decline. And you know what his argument has been so far? His argument has been that, well, the banking crisis where fringe banks collapsed has increased our view of recession. Okay, but what about earnings? Facebook and Meta and or Microsoft are just propping up the market. That's going to end. Earnings are going to come down. Okay, so why? Oh, well, when the Treasury Department expands the debt ceiling, then they're going to issue more Treasury bonds. That'll lower the price of Treasury bonds, and that'll increase yields. Has he considered the counter argument that perhaps when the debt ceiling crisis is over, people might actually rush to buy bonds at the higher yields that we still have today, because they might be assuming that yields are going to plummet going into the future? Apparently not. So far, I have to say, to argue that the S&P 500 has another 2,200% or 22% drop ahead of it, pretty weak arguments from this individual thus far. Morgan Stanley gives a better argument, which is just strictly focused on, Mike Wilson, the Bears over there, which is strictly focused on, look, earnings per share, way too high. Now, I agree with that for many stocks, whether it's your consumer staples, some of your defensives, maybe even your military industrial complex ones. I actually think we're going to have growth at any cost very soon, because folks are going to see, we're trending pretty close to recessionary environment, maybe not necessarily in recession, but let's keep going where the money's been good, which is mega cap tech and pricing power style stocks. But anyway, let's listen to the rest of his bear argument here.
The questions now about the no landing scenario, where people say, why do we have to land at all? And I would say,
what do you mean no landing?
Meaning like, listen, why can't this persist? You have a shortage of labor. Why does there have to be a recession? And the answer, I think, is if you're going to have a typical business cycle where the Fed isn't going to monkey around with it, you're going to have higher inflation and higher long-term interest rates as a result. And that means, like, the no landing scenario means you land into the side of a mountain or something. Like, I would much rather have the weakness in the economy and the markets this year before more excesses get built up, because to me it's much more painful that way when it eventually comes.
Okay, so in other words, the argument being made here that, hey, it's actually worse if we end up with not having a slowdown in the markets as soon as possible. I don't know. We'll see. Not the best argument, in my opinion. I think he could have done a lot better. What I prefer to look at lately is actually the Atlanta Fed Now Real GDP Tracker. I think that one's pretty decent and has been pretty functional lately in terms of helping us guide where the market may actually be heading. So let's go ahead and pull up the Atlanta Now GDP Tracker. That's right here. And what we could see is that the sort of towards the end of January, the Atlanta's GDP estimate was sitting just below 1%, and that ran over 3% right around the time of the banking crisis. But markets apparently sent signals to the Atlanta Fed that GDP might actually decline closer to 2% by where we stand today, April 11th. So fresh data here. Now, what's incredible about the Atlanta real GDP indicator is it's been decently accurate. And it shows that the stock market is actually potentially underpricing in how strong the economy is. Now, sure, is the labor market still tight? Of course. Are there still potentially some stickinesses in inflation? Of course. But with patience, and if the market can't keep chugging along, maybe we're not looking at a negative GDP. We're not actually knocking on the door of any more of a recession than we had technically had in 2022. Latest estimate for the real now GDP measure is 2.2%. Now, I think it's worth looking at what consumers have to say in this. So let's jump on over to a little segment on the consumer. Morgan Stanley just put together, well, hold on here. Let me do this. Let's get rid of this. There we go. Morgan Stanley just put together a phenomenal piece on the consumer, and the consumer is a big piece for what could be happening with a recession. We just listened to a dude on CNBC trying to articulate weekly why he thinks the stock market is going to drop 22%, and basically says that in order for us to get through the next cycle, that is to get to, a bottom and then a recovery, you've got to go through a recession. You've got to have some kind of crash, and gives really weak arguments suggesting that, treasury yields are going to rise when the debt ceiling gets expanded because the treasury will issue more treasuries, but potentially totally misses counter arguments that, well, if the economy is stronger, then consumers are still spending money, then people might want to lock in those higher yields on treasuries and actually end up leading to more buying for treasuries and lower yields. So wasn't a big fan of this Mr. CNBC guy, but what I am a fan of is data. Let's take a look at some of this from Morgan Stanley here on the consumer and remind you that tomorrow is the expiration of the coupon codes linked down below. So what do we have here? Consumers are more confident in their ability to access credit than their ability to afford it. Over a quarter of consumers are likely to apply for a new credit card over the next 6 months, which skews much higher amongst the higher income households. 41% rather, of those making $100,000 plus plan to apply for a new credit card. We also asked consumers how confident they are that they would be approved for different types of loans if they were to afford these loans. New credit cards, and then we get into here, looking at the net spread between those who are confident of getting approved versus not confident, suggests that consumers are most confident that they would be approved for new credit and are least confident that they would be approved for a new mortgage. So in other words, people really open to the idea of, don't worry, we can get higher consumer debt, but not necessarily asset-backed debt because interest rates have gone up so much higher on mortgages. And even though credit card rates have gone up, don't worry, we still think we can get access to our dangerous debt. Higher percentage of consumers believe they can't afford a mortgage or a car loan or a personal loan. All of these net 12%, net 5%, net 4%. So you're seeing some potential fear that maybe the only type of credit you could get your hands on nowadays is actually a credit card. And consumers' views on the accessibility and affordability of credit varies heavily by income level. Higher income consumers, like those making more than $100,000, are confident they would be approved for any type of loan and are confident they could afford them, whereas consumers making less than 50 are not as confident. I mean, I feel like that's almost normal. That's not a surprise. Consumers intend to travel but are budget conscious. Consumers continue to report robust intentions to follow through on travel without flights, 65%, with flights, 56%, internationally, 42%, all in line with the last 2 months. So no inflection yet on consumers' willingness to travel over the last 2 months. 6 in 10 consumers are planning to travel over the next 6 months, up 57% from the same time last year, in line with 2021. And even with higher intentions to travel, consumers are mindful of their budgets. Okay, not that big of a surprise here. Household savings reserves are flat. Now, this is interesting. This is Morgan Stanley's POV. This is different from what Bank of America and JP Morgan have suggested. Household savings reserves are in line with the previous wave. 24% of consumers do not have any savings. 34% have 3 months or less. 28% have 4 to 12 months. And upper income households have around 4.8. Well, hold on. Let's see here. Let's see. 28% have 4 to 12 months. 14% have more than a year. This yields to an average reserve of 4.8 months, skewing higher amongst higher income households, obviously. Majority of consumers surveyed say they are likely to cut back on spending over the next 6 months because of inflation and plan savings and credit cards to fund their spending. Now, I have a question here. I do wonder if people applying for new credit cards at higher income levels aren't necessarily applying for new credit cards because they need the debt, but maybe they're applying for new credit cards because they want the new rewards points or whatever they're getting with a new credit card. Low income consumers are generally more worried about the ability to pay rent and pay debts, while upper income consumers over index on concerns about their investments, political environment in the United States, and geopolitical concerns. That's interesting. So if you look at this chart here and just break this down, if you look at the lower income segment, which is the blue and the green bar, the blue and the green bar is much higher over here in the coping with inflation segment. Blue and green, you've got blue and green over here. What is that? Political environment lower for blue and green. Political environment not able to repay debts rather over here, higher for blue and green. That makes sense. Whereas orange, that higher income segment, really low fear about not being able to pay rent, not being able to pay their loans, potential salary cut, very little worry among all of that. Whereas they're more worried about geopolitics, potential of losing money in the stock market or the political environment. That's fascinating. It's a good little difference there, and I think is a reasonable conclusion we can make. With even without the data. Savings versus pre-COVID, we continue to see a substantial share of consumers, 40%, reporting that they have less savings now than they did before COVID. Among around 30% have a similar level of savings, and 31% have a higher level. Okay, well, let's take a look at this. So we have a much lower segment is over here, and the much higher segment is down here. So upper income consumers are more likely to have a higher level of savings. Well, of course. And that would basically be it's kind of weird that they threw this at the bottom, because I'm assuming that people with much higher current savings, these would be your upper class individuals here, but they haven't broken those down by color. Okay. Overall, 30% or 36% flat of consumers reported missed or late payments. Lower 40% and mid-income consumers, 35% consumers are more likely to have missed payments versus high-income consumers, just 26%. I mean, this makes sense. Higher income, less likely to miss your payments, less likely to miss a rent payment. That's pretty logical. Consumer spending intentions are reverting to January levels as consumer spending, as of consumers expecting to spend more next month, and 17% expecting. Okay. Well, this is a little bit of a tricky one. Let's use the chart instead of their verbiage to look at this. So overall household dollar spending over the next month among the total. So less versus last month, expected to spend more versus the last month is here. Less is green, and about the same as last month. And these look like weekly analyses here. So most people seem to be in this about the same spending category. It doesn't seem like there's very terribly much of a difference here in people wanting to spend less, with the exception of what we had over here in mid-June. It did mid-June to about October seemed like it could have been about the bottom of the stock market. So it makes you wonder if there's an alignment over here. Expecting to spend more, and that ate from this middle group too. Expecting to spend more. Actually, interesting trend up. Let's try to just look at a trend line on this. Look at this. If I draw a trend line, if we actually get a trend line here. If we draw a trend line, it's a little bit of a messy trend line. There we go. If I can recorrect that a little bit. There we go. I'd say that's a decent trend up on individuals who are willing to spend more. But then again, this segment over here, yeah, that seems to be consistent. Slight decline over here in those willing to spend less. There is entirely the possibility that this ends up being that kind of recessionary environment where everybody thinks we're going into recession. All the economists think we're going into recession, but people just keep spending through it. Consumer electronics and computers continue to post lower negative net spending compared to previous eras. And this is why we've seen a lot of bearishness around chip stocks, although they've rebounded quite well during the first 3 months of the year here. Plans to cut back on spending due to inflation. Majority of consumers surveyed continue to say they are likely to cut back on spending over the next 6 months because of inflation. Another 21% say they're not cutting back. Yeah. All right. What else do we have in this piece? Let's see here. I think this is the last page right here. Restaurant spending continued to be most at risk of a consumer pullback. That's probably the one place I don't want to invest right now is restaurants. Oh, actually, I almost never want to invest in restaurants. I feel like the margins are terrible here. Other discretionary categories such as clothing and footwear, live entertainment, and leisure travel are also popular areas to cut back. So it makes you wonder. The consumer seems to be relatively mixed. I mean, yeah, the lower end, and we've been thinking this forever. I mean, nothing's new here. Lower end consumers are more likely to miss payments, are less likely to want to travel, and potentially have less savings. But none of that is really new information. This is pretty redundant. So I'm a big fan of sticking here with pricing power. I don't think this pricing power style stocks, especially those that appeal to higher income individuals. But I don't know that this really changes anything here. So, okay, let's get into, we are going to do a public opening bell here, and then we're going to jump into one more segment, and then we will head on over to the course member live stream. So let us get the opening bell ready, and we will listen in. Mhm.
People making less.
Well, in that case, he should be happy with Friday's number. Lowest month-on-month gain in wages in a year.
You can't have slowing. I think he wants deep. Look, Mester is, wants us selling apples. She wants us selling. Do you know that? With Mester, I'm going to go buy a lot of apples. Sell them right out here where gold used to trade. Yeah, I got apples here. Macintosh. Yeah, I got apples here. Cortland.
Red Delicious.
Red Delicious.
Randy Smith.
Jeez. But you're a sandwich man. I'm an apple seller.
Let's get to the opening bell on the CNBC Real-Time Exchange. With the big board today, it is Sam's Club, a subsidiary of Walmart, celebrating Sam's Club's 40th anniversary.
And they had good numbers. And that was one of the reasons why Walmart went from 140 to 150. Dave, were you here during that analyst meeting? It was so positive.
I don't think I was.
Sam's
Jim.
was good?
No, I think I missed that.
Well, you missed a good one. Sam's had good numbers.
All right, there's the opening bell, vastly green. I think the most important thing that we want to look at here is let's just talk about tomorrow. So most important, now obviously we've got green going into the market here on the eve of inflation. We've got Bitcoin over 30,000. In my opinion, the absolute most important thing coming up is the inflation report tomorrow. So let's just talk about my expectations around this inflation report, specifically what I'm looking for. And I'll put together all of sort of the research that we've been doing to put my thinking hat on and make a prediction here about inflation. So I want to be very crystal clear here. I think that inflation will end up proving to be longer term transitory. There's one thing everybody learned around this cycle, and it's patience. Everything took a lot longer than people thought. The Fed's hiking cycle came later than folks thought. It took longer than folks thought. Things started breaking, but quite frankly, the banking crisis and things started breaking really, in my opinion, aren't red flag that the Fed has over-tightened or has created a recessionary environment. I think that the fringes suffer when there's a tightening cycle. The companies that are zombie companies with poor risk management procedures, the companies that have poor cash flow, the companies with exposure to risky assets like Silicon Valley Bank, startup sector, Signature Bank, the crypto sector, and Credit Suisse has been plagued with scandals and poor auditing and risk management procedures for decades. All of these companies collapsing really serves as no surprise, and in my opinion, not a sign of a greater financial crisis, but rather of a normal weeding out cycle that you would get in a crisis. That is normal. Companies that should not exist should die at some point. And that is what cycles do. The bear markets take out the bad, the junk, and it's like a hurricane that comes through and weeds all the trees. After a hurricane, everything looks super clean around, with the exception of all the debris on the floor. But you look around, it's like, wow, everything feels like it just got a big bath. Everything just got blown around. I grew up in South Florida, so it's relatable to me. But anyway, point being, this recessionary environment could very much be like an economic hurricane, where just the weak got cleared out, and the excess labor got cleared out, and they were encouraged to go be productive somewhere else. And we could end up coming out of this recessionary style environment with a substantially larger or more productive economy with higher GDP growth, which lowers the burden of our national debt anyway. And we could come out of this much more productive than when we went into this. In other words, all of this insane expansion of the money supply from the stimulus era could actually end up helping create this bubble environment where everybody got showered with money to go innovate and build and build and build. Then you run through and you basically destroy everything that couldn't figure out how to make it with unlimited amounts of money. So try making it with restricted money. And now, hopefully, going forward, you have the most efficient businesses left over that got stimulated massively and are still getting stimulated, whether it's chips, artificial intelligence, electric vehicles, energy, you name it. So regarding CPI tomorrow, and these, by the way, all my favorite pricing power stocks, my favorite stocks, you can see them, my actively managed ETF, the courses on building your wealth, everything. Just go to meetkevin.com. We've got a coupon code expiring tomorrow, and the price will be going up after April 12th. So CPI per Bloomberg, we know, is expected to come in at 0.2% on the month-over-month level, and the year-over-year level is expected to come in at 5.1%, which is fantastic. These are big moves to the downside, from 6% to 5.1% from the prior read year-over-year. That's great. We don't get as much of a movement in core or when we exclude food and energy, so a lot of this being driven by a fall in food and energy prices. But if we look at the non-core, what we're really looking for is just starting signs of disinflation in services. That's exactly what Jerome Powell told us to pay attention to. He said, listen, goods deflation is here. That needs to hold. So we need to keep seeing weakness in used autos, new autos, durables, any kind of goods outside of foods and energy. Let's continue to see weakening there. Then, at some point, we're going to get the rollover of housing data. That is, we will start getting weaker housing data for rents, and that will help lower owners' equivalent rents. That's part 2. But part 3, that doesn't have the forecast yet, that isn't expected just yet to roll over like housing or goods. Part 3 is that core services disinflation. Your attorneys, your financial advisors, your haircut, your medical supply or your medical services, rather. All of these sectors are where we're looking for weakness. And Jerome Powell expects to see the process of, in his words, disinflation to begin there soon. My hope is we start seeing the beginning of disinflation there. Now, I think that inflation is going to just remarkably plummet and come in substantially low, and it'll all be over tomorrow. In other words, all the inflation will be gone tomorrow, and the Fed can finally start cutting interest rates more, much like the bond market anticipates. No, I do think, much like we saw last year, that the bond market is a little bit ambitious in their Fed rate cut cycle. Remember last year what happened? We were expecting at the end of last year that the Federal Reserve was going to cut somewhere between 1.5 to 2 percentage points by the end of 2023. Those expectations vanished very quickly. The reason those expectations vanished very quickly is because we had hot January numbers. And all of a sudden, we went from pricing in rate cuts to pricing in no rate cuts. But what interestingly happened is the stock market actually rallied substantially in the first 3 months of the year. So is it possible that that same thing could happen again? My thesis is yes. We could start seeing disinflation on the services side. We're clearly on the path towards disinflation. However, we're not in as bad of a recessionary environment thanks to the banking crisis as people expect. As a result, what happens? We have to start pricing in higher interest rates for longer. But the last time we did that, between December and about February, stocks actually rallied. Now, it's possible that they rallied because of tax loss harvesting and rebuying in January. But take a look at this particular chart. This shows us the current implied overnight rates and rate cuts. And what we're seeing is this plummeting. In other words, we'll get to a terminal of about 5.25 with about a 65% chance by June 14th. And then we expect to see this plummeting in rates where we could potentially be cutting rates as much as 2.75% as soon as January 2024 and the December cycle or December meeting in 2023. That's entirely possible. But I think personally it's unlikely we're going to see cuts that dramatic unless, of course, the economy is absolutely going into a recession. Based on the Atlanta GDP Now forecast, GDP today could still be around 2.1%. And if that holds even above 0.5% through this summer, this scary Q2, Q3 era that people are really worried about, then it's entirely possible that we could see inflation continue to trend down while stocks continue to trend up. And we price in higher for longer. Now, that is what many people call a Goldilocks scenario. And I think they use that because they're trying to say it's unrealistic. It's not going to happen. It's very unlikely. But let's think about this graphically for a moment, how this could look. And then we'll also combine real estate. So let's look at this graphically for a moment. So what do we have? We're over here in December of 2022, and we think that rates are going to be lower. So we price in lower rates, right? What happens come about January and February? Well, we start pricing in higher rates. Then we get the banking crisis. And what do we get with the banking crisis over in March? Well, we start pricing in lower rates for that December era of 2023. So let's go ahead and write December over here. March, the banking crisis happens, so we get higher for longer. Up here, this will be our rates for green here. And now we're pricing in lower again, right? This is going to be what is being priced in. Rates, or let's write in, we'll say rates now for 411. But let's do a rates likely trajectory. And this is going to be sort of more of what I believe in terms of the trajectory. So we'll go ahead and follow the light green over here. We'll get our 5.25, but we potentially stay there at a pause for longer. This is that higher for longer argument, right? And the reason I think that maybe we don't actually end up getting any kind of cut until, let's say, September, and we sit at this pause level for longer, is because we know the Federal Reserve does not want to make the same mistake that they made in none other than the 1970s. In the 1970s, the Fed took this approach of start, stop with rates, and that ended up being a big mistake because it broke inflation expectations. Because inflation expectations have been so incredibly anchored over this entire cycle, I personally think it's highly likely that we're going to have a pause for much longer than markets are anticipating. Now, what does that mean potentially for the stock market? Well, I think a pause for longer is actually a good thing. You still get your sort of the Fed suggesting, hey, we're conquering inflation, we're going to pause. So you get the benefit. What does this do? It creates we'll put benefits. It creates the benefit of we didn't break everything, so didn't over tighten, right? Benefits of pause for longer. That's what I'm calling it. The benefits of a pause for longer. We didn't break everything. We didn't over tighten, which Jay Powell says, hey, there's no evidence that we've over tightened, which I would argue differently that there are some evidences that we've over tightened. But anyway, benefits of pause for longer. We didn't break everything. We don't repeat the mistakes of the 70s that created hyperinflation. But in addition to that benefit, we can support a Nike swoosh stock market. Now, why is that? Well, first of all, it is what has been happening. As interest rates were actually projected to go up, what happened? Well, the stock market actually also went up. And even though we've been somewhat volatile over here, we've been somewhat stable. And so the Nike swoosh thesis, if we kind of draw the Nike swoosh, is sort of a big down and then a big trend channel up with a lot of volatility in it. We could see our Nike swoosh, this Nike swoosh expecting to take potentially 10 years as we start our next bull run. Now, what does that potentially mean for real estate? Well, real estate is probably the biggest outlier right now. We really don't know And that's because even though Treasury yields have come down, spreads on mortgages have gone up. So mortgages are still pretty expensive. And right now, because there's such a lack of inventory, you're actually seeing prices in many markets start rising year over year again. And they're escaping that potential year over year negativity that we would have expected for next month. May had prices even just stayed level. We're actually starting to see those move up. Now, that could turn upside down. In other words, real estate could get hit substantially harder in the event inventory skyrockets as REITs start liquidating or professional institutional investors start liquidating. I think it's unlikely that any kind of liquidations are going to come from regular households via short sales or foreclosures or whatever. So instead, I think it's likely that the stock market continues its sort of Nike swoosh on trend up. We have this higher for longer regime in the stock market, right? And this is Kevin's crystal ball. But I do think that this takes a lot longer to rotate down. I think the Fed is going to be okay with slightly higher inflation for longer, via no wage price spiral that we already know the conditions of that are not present. We know that very clearly looking at almost any earnings call from the last 3 to 6 months of companies who employ or hire labor. But also the principle of flexible average inflation targeting, which would suggest that the Fed is okay with a higher inflation rate for longer because as long as it averages 2% over the long term, they're okay with that. And they can take opportunistic inflation to get there rather than breaking markets. So what you have here is this combination of, I think the bond market is a little enthusiastic, assuming that we're going into this deep, dark recession. I think that upper end consumers still have plenty of money to spend and probably will for another year. But by that time, we should be convinced that inflation is actually lower, which might loosen banking standards again as rates slowly start coming down. So I think the loosening of banking standards comes when inflation is convincingly down, right? And then that's actually where we cut. When the Fed cuts, it's a huge indicator this cycle that they've won on inflation. The Fed winning on inflation is everything here, folks. This is not the Fed cutting because they care about recession or not. They will gladly force us into a recession if they need to. What the Fed cares about is conquering inflation. And that's, I think, why we end up with a pause for a lot longer before we start getting cuts. I think the bond market is being a little excited anticipating as many cuts. Now, what I do think if I were to draw in real estate here, this is going to be a little bit trickier, but let's try to make a projection here with real estate. So I think that real estate prices stayed higher for longer. I think we had our adjustment down in real estate, about 10%, 20% in some areas. You're starting to see this right now where you're trending up. In Florida, for example, you're actually positive. So you're starting to see a trend up. The only way you could really push that down is if you get substantial inventory increases, which so far we're not seeing. But people right now seem to be comfortable with these higher rates, and it's leading to more of a soft appreciating market. Now, if we then, as interest rates potentially start coming down, the traditional argument is that, okay, well, rates are starting to come down as the Fed cuts. The traditional argument is, oh, great, well, that means raise prices are going to go up again, right? Not necessarily. What is actually entirely possible with real estate is that as rates come down, more people decide to sell. People who've been locked in and they didn't want to take a high 7% loan or whatever. And you actually keep this pressure down on real estate, where as you're increasing inventory and as rates are coming down, you're actually just staying stable. And I actually think this is going to create a wonderful window of opportunity to buy. I don't think you necessarily have to try to time here, or if we end up getting any kind of like little bit of a dip again over here, I don't think you have to be perfect on that. I think as an investor, you want to look at this future over here. And there are two main investments that you want to be making right now. Well, maybe not necessarily immediately right now for real estate, but soon you want to be getting into real estate. Obviously, I have a course on teaching you exactly how to go from zero to millionaire through real estate investing. And I think this flat period of time we might face, or even a slight dip again, we don't know. It's going to be one of those, I think. Although it's also possible that real estate just goes to the moon again as the money printer is turned on. Though I think that's less likely. I think first we go through some form of inventory shock, which either drives prices down more or it just levels them out, right? And that will create a beautiful window of opportunity, which we'll have more insight on by the third quarter. That's when I expect to start buying for my real estate startup. So I think by the third quarter, we start having some nice opportunities to really start buying in sort of this flatter market for longer. At the same time, and in the meantime, hopping onto this Nike swoosh recovery of the stock market, trending up as inflation proves to go away. So this is a pretty detailed, in my opinion, thesis going forward. Now, what are the risk factors here? The risk factors that would encourage you to get life insurance in as little as 5 minutes by going to kevin.com/life. All right, risk factors. Remember, none of this is financial advice. It's non-personal financial advice. I am a licensed financial advisor, but I don't know you, so I can't give you personal financial advice. So when I say I think it makes sense to go long stocks, which I've been saying for a while now, and soon it's going to make sense to really go long real estate and then acquire as much assets as you can over this next decade, that's not personalized financial advice. I just think it's good financial advice, broad, generic financial advice, right? I think everybody should be doing that. So what are the risk factors here? Well, obviously, the risk factor is that if we have sticky inflation, which we'll see more about tomorrow, if we have sticky inflation on services, then expectations on inflation could unanchor, and we end up getting Paul Volckered, right? And then what you have is the worst case scenario. Worst case. There we go. So that's the worst case scenario, is we get Paul Volcker. That's deep, dark, dirty recession, right? This would be very bad. It's entirely possible that this could happen. I would put about a 5% risk on this. I think you're 5% looking at Paul Volcker, and I think you're probably more like a 20% recession for longer. So I would call it like a shallow, low growth recession for longer. Ironically, a low growth recession actually leads to a flight towards growth stocks like big tech, safe growth stocks, safe ones. So I think that's why you're not seeing as much of a sell-off on some of the mega cap names. We know that yesterday Apple had a pretty big hit in terms of their numbers for PC shipments, Mac shipments, but the darn thing's down like 1.5% to 2%, so not that big of a deal. The stock market is rotating down at the time of recording this video, and I think a lot of that will be in anticipation of CPI tomorrow. So I wouldn't judge the content in this video by stock market performance today. I would go into CPI data tomorrow and see, does this make sense? Is it possible that we could actually end up with the benefits of pause for longer and disinflation, leading to great opportunities for us to buy in the Nike swoosh and in the real estate flatness, while at the same time recognizing that, yes, there are risks of Paul Volcker, but they seem far-fetched. In other words, I think it's also worth noting that any kind of de-dollarization, if you've watched any of my videos on the dollar of the past 3 weeks here, I think this is also a far-fetched idea. I think war with Taiwan is far-fetched. So I think these are risks that are less likely, in my opinion. They do have some merit, though. So we'll see. This is in my opinion something that is sort of an investing outlook. And now within this scope, we could explore or companies within that scope. So that's my thesis on what's going on in markets. So hopefully that is helpful to you. Make sure to check out those programs on Building Your Wealth link down below. I'm hopping over to the course member live stream now. Appreciate y'all being here.